Accounting was originally designed to track wealth. Over time, though, it's tracked how we do business. So, to understand accounting, you have to understand business. Let's walk through the life cycle of a business. We start with an idea, a good idea that will make a lot of money. However, most of the people who come up with good ideas don't have the money to fund that idea. So, the inventor goes looking for funding from investors. We have two options for investors: lenders or owners. Lenders provide cash in exchange for repayment plus interest. Owners provide cash in exchange for a stake in the business, which gives them control and a chance to make additional profits above interest. These investors provide us with what we need most: money. And with that investment, we can start our business. We then use that money to buy assets: buildings, inventory, machinery. The goal is to turn the cash from our investors into the assets we need to run our business effectively. We then move on to the next step, which is selling the assets we have purchased or produced. We give our customers our product and they give us what we need most: money. At the end of each period, we take the money we have earned and either buy more assets or give it back to our investors. There are two investor types: lenders, which have interest expense associated with the money, which results in less profit, or our owners, which don't have any interest expense associated, so higher profits. The accounting system is designed to track several things: the money coming in from our investors, the money that was spent to purchase assets, the way that we use those assets to generate sales, the profit we make from our sales, and the way we use those profits to repay our investors, including the original inventor, or grow our business.
Dad.
These two equations are the basis for everything that we do in accounting. Most people get hung up on these equations, but just because these are terms we don't use all the time. Let's make sure that you are comfortable with all of them. Debit just means left, and credit just means right. The other equation is the one most people think of when they think of accounting. Assets equals liabilities plus equity. Assets are things that we own, usually physical property, like a building, trucks, or inventory, but it can also be ideas that we own, like a patent or a copyright. Anything that we use to make money is considered an asset. The other side of the equation is a bit more abstract than the physical assets we own. The best way to think about this is, how did we get the money to pay for those assets? Remember from a previous slide, there is two options: lenders or investors. Lenders expect their money back, so that's a liability. Investors own a piece of the company, so that's equity. All that accounting really comes down to is these two equations and our basic goal to track our assets and who has claim to those assets. Since this is all based in math, we have to follow basic mathematical rules and be sure that both equations are balanced at all times. So, the left-hand side, debits, needs to match the right-hand side, credits, and our assets needs to balance with who can claim those assets or who invested the cash so that we could purchase those assets. All accounting comes down to these two basic ideas. Every entry, every calculation, and every financial report needs to follow them. And it works just as well for a mom and pop shop as it does for a Fortune 500 company. Let's take a look at this process in a little more detail, since it's an important concept for anyone who wants to understand or do accounting. Remember our basic equation: assets equals liabilities plus equity. Assets are the things that we own. Liabilities and equity are who has claim to those assets. So we take our idea to a banker. The banker likes the idea and gives us cash, so we need to show that we got an asset. But we promise to pay that money back, so we need to show that we also have a liability. For owners, we would do the same thing. They give us cash, so we need to record the asset. And now that they own shares of our stock, we need to record that as equity as well. So again, we need to show that we have more money as an asset, but this money belongs to the owners. If we were to liquidate right now, the banker would get back their piece, and the owners would get back theirs. Now that we have the money that we need, we turn that money into assets by buying factories, equipment, or inventory. But nothing's changed. The bank still is owed their piece, and our owners their piece. So if we were to liquidate, now they would get a share of that factory, equipment, or inventory. The basic idea is that when the debit side goes up, the credit side also has to go up. And the opposite is also true. If the debit side goes down, the credit side also has to go down. This could happen as we repay our investors. If we pay the bank, then we owe the bank less. We have less cash, but we also have less debt. Keep in mind though, if things are stolen or embezzled, we have fewer assets, but that doesn't change what we owe the bank. It will only change what the owners get. We also have another equation to keep in balance. Debits equals credits. To do that, we decided to break down our system into a set of accounts, one for each asset, liability, and equity. Each of these accounts gets two columns or sides, debit and credit. To keep the two equations balanced, we decided that if an asset goes up, we record it on the debit side, and if it goes down, we record it on the credit side. And if assets go up, then liabilities and equity also have to go up. And since debits have to equal credits, we'll put that increase on the credit side, since the assets had it on the debit side. Now, both my assets and my liabilities and equity have gone up, and my debits equal my credits. So both equations stay in balance. Isn't that cool? The opposite is also true. If assets go down, we'll use a credit to show that it's decreasing, and when assets go down, liabilities and equity have to go down. Those accounts decrease with a debit. By having each side of the equation, assets equals liabilities plus equity, increase on opposite side of our accounts, debits and credits, we ensure that both equations always stay in balance. If we've done that correctly, our assets should have debit balances, and liabilities and equity should have credit balances. This provides another check to see if you're doing things correctly. For example, if you end up with inventory having a credit balance, you know you've done something wrong. Now that we've talked about the accounting equations, how they work, and why we set them up the way we did, let's go through an example. Let's start out with a few basic accounts. We'll have cash on the asset side, a liability account, and an equity account on this side. First, we go to the bank, explain our good idea, and they agree to lend us money. So, we got money, that's an asset, it increases with a debit, and we now owe the bank money, that's a liability, which increases with a credit. So, both of our equations are in balance. Our assets equals our liabilities, and our debits equal our credits. The books also show that if our business was shut down, that money is owed to the bank. Then we go to potential owners, pitch our idea, and they agree to give us money in exchange for stock in our company. So we got cash, increases with a debit, and increase in equity with a credit. So again, both of our equations are balanced. Our assets equal our equity, and our debits equal our credits. The books also reflect that this money is owed to our owners. Let's take some of the money we got from financing and buy some inventory. Since we're using cash, it's decreasing, and assets decrease with a credit, but we're also purchasing inventory, which is an asset, and increases with a debit. So our debits and credits are still equal, and our other equation balances as well because there's an equal increase and decrease in assets on one side. Next, we get to sell our inventory. So inventory is going to drop because we sold it, and that's an asset which decreases with a credit, but someone has to pay for that. So is it a liability or an equity? Liabilities don't change because that's a contract we have with the bank, so it's going to affect the owners. For example, to start we have $100 of assets in cash and inventory, and we got $50 from the bank, a liability, and $50 from our owner, which is an equity account. Then, if we sell $10 of inventory, our assets are down to $90, but because we have a contract with the bank, we still owe them $50, so to balance, our owners only get $40. But there's always a flip side to this. If I sell inventory, that means I also received cash from my customer. We'll show that with a debit to cash because it's an asset. Then we need to keep that equation balanced. So the credit goes to equity. And that doesn't affect the bank because we still have a contract with them saying we owe them $50. So just like the cost of a sale affects the owners, so does the benefit. Let's clarify that we aren't sending the owners a bill for the inventory or a check for the sale. The assets are just fluctuating on the left, and then who gets a claim on those assets is fluctuating on the right. What we owe the bank is a contract, so that amount cannot change. That leaves equity for the amount to change. Over time, we're going to have enough cash from all of those sales to pay back the bank. So cash will go down, which will be a credit to the asset, and our liability will go down as well with a debit. So the bank is probably happy to get their cash back, but now they don't have any claim on our assets anymore. Again, both of our equations keep us in balance. Our debits equal our credits, and our assets equal our liabilities. Let's take a closer look at the equity account. Notice how much is going on in this account. We break up what's going on in total assets by having separate accounts such as cash, inventory, or fixed assets. But anytime we spend or earn money as part of our normal business operations, it affects our equity holders. And that becomes a problem because this account is so complex. Our job as accountants is to provide as much information possible to decision makers. So we decided to do the same thing that we can do with assets to equity. Let's break it down into a bunch of smaller accounts, and if we add up those balances, we'll get our total for equity. Let's start with the money our owners gave us. They invested in our company, so let's have an account called investment, or common stock if it's a corporation. Then we created a revenue account so that we could track how much equity has gone up this period because of the sales that we made. Then we created expense accounts so that we could track how much equity goes down because of the expenses of running our business. You'll notice that this time we gave it a debit balance. Because equity has a credit balance and expenses are tracking equity going down, it needs to have a debit balance. Finally, we create an account for withdrawals or dividends so that we could track how much equity goes down when we give assets back to our owners. So again, this is showing a drop in equity, so it needs to have a debit balance. Since our goal is to track and provide detailed information, we don't need just one revenue or one expense account. We can create as many as we need to give accurate and complete information. It's important for decision makers to have accurate information so they can see the relationship between revenues and expenses and if they're making money or losing money. That's why the accounts have the balances that they do. It's all designed to help track information as accurately as possible by keeping our two main equations in balance. So assets always increase with a debit and decrease with a credit. Liabilities and equity always increase with a credit and decrease with a debit. Keep in mind that expense and dividends accounts are still equity accounts, but they're designed to show decreases in equity, so they increase with a debit and decrease with a credit. Hopefully that logic makes sense, but sometimes it takes a while to keep it all straight. So as you're getting started, you might want to use this shortcut to help you remember the balances in the accounts. DEADCOLR. Debits are expenses, assets, and dividends. Credits are owner's equity, liabilities, and revenues. This process of recording transactions, including dividing our equity into smaller accounts and bringing them back again, is called the accounting cycle. Most people talk about it on an annual basis, though, since that accounts for all of the fluctuations a business might experience during the year. You can run these reports on any period that you like, though. Quarter, month, even a week. It all depends what kind of information you want to see.
Damn it!
It's okay.
Cool.
You want me to say it? Isn't that cool?
It's so cool.
Yeah. I love accounting. Yeah, I'm sure you're going to take that and put it somewhere.
Oh, for sure.
Okay.